Welcome back. You're watching The Money Show, and it's time to answer your financial portfolio queries. And you must be having a lot of financial goals, but do you have a strategy which is aligned with these financial goals? Let's find out all of that, and let's help you navigate all of your important financial life questions. Today, I have with me Shweta Rajani, Head Mutual Funds, Anand Rathi Wealth, who will be answering all of your questions. Shweta, good evening and welcome to the show. But before I go on my viewer question, let's also flash our WhatsApp number and email ID where our viewers can send across their queries. The WhatsApp number is 865-797-4571 and the email ID is themoneyshow@etnow.tv. All right, so let's begin. And Raja Maheshwaran's question, I'm going to read out. This question is sent by mail, by email. So he says that between 2017-2099, he's invested overall 50,000 in 5 different mutual funds. He's got Tata, Birla, DSP, ITFC and Mahindra Manulife. And he also wants to understand or help Shweta figure out as to whether the profit threshold of 1 lakh is applicable to each individual investment separately or to the total aggregate of 5 investments. Additionally, is this profit threshold applicable to the entire holding period or to each respective financial year? All his investments are in equity funds. So we don't have him on the phone line, but this is a question via email. Very interesting question. And in fact, today we are getting a lot of tax related questions on mutual funds also. So that's a very interesting aspect. Looks, people are really getting aware and want more information on the tax implications on the investment, Shweta. So how will you answer it?
Good evening, Kavita. I also think, we're getting closer to the tax filing maturity date. So people are, wanting to understand the tax implications. So, coming to the specific query, sir, one thing that you need to understand is that the 1 lakh exemption, which is there, it takes into account all your equity instruments. So whether it's through equity mutual funds or, direct stocks that you may have, all the long-term gains that you would have had are taken into account. Second, 1 lakh is not per scheme, so it is at an aggregate level, not just mutual funds but other equity funds too, like I clarified earlier. And third, you asked whether it's an aggregate. No, it's not aggregate. It's for a financial year. So I'm just going to explain it to you with one example. Let's say across these 5 schemes, you have 50,000 as your cost value. The current value is 2 lakhs. Now there is a capital gain of 1.5 lakh. You will get the exemption on 1 lakh. On 50,000, you will have to pay your long-term capital gain tax, which would be at the rate of 10%. You can choose to only book 1 lakh profit this year and get the entire benefit. Next year, again, you can, to the extent of 50,000 or whatever is your capital gain, you can book it to be within that 1 lakh limit. So you can use that benefit. I hope I've clarified your doubt.
All right. All right. So that answers Raja Maheshwaran's query also. And let's move on to our viewer that's connected on the phone line. I have Mr. Rama Jayanti with me on the phone line connected. Hi, good evening, sir. How are you doing today?
Yeah, hi. I'm good. And you?
I'm good. Thank you so much for asking. So as for the details sent across, sir, you say that you can invest 45,000 per month in SIP for 5 years. And you also want to know what's the right kind of portfolio mix considering you want to invest in mutual funds. And you also want a corpus to meet any emergency. So any specific financial goal that's coming up or lined up after 5 years, and what's the exact corpus that you're looking at?
I'm looking for some growth, some kind of exit to get given because I'm already covered for some risk. So I have some good liquid funds with me. So I'm looking for some 30-40% depreciation overall. So I'm not really worried about the risk perspective of it because there is some surplus sitting there in other instruments, which can be liquidated immediately. So. My only objective of the goal is the next 5 years, how can I, get some 30-40%. That's everything being taken care of. Yeah.
Sure, sure. Looking at the time frame that you have mentioned, just 5 years, we really can't go aggressive in this strategy because we are talking about having your exposure in equity. So that has to be very moderate and balanced. And you also want an emergency corporate. So let's connect with our expert and let's figure out a strategy for you. So, Shweta, interesting question, but also a condition of 5 years where you really can't go aggressive, and you'll have to be conservative slightly in your approach to save the capital that he's also wanting to invest. So yeah, how can he accomplish his goal or achieve that?
Yes. Ramas, what I would suggest is one, at a portfolio level, please have a check on what your asset allocation is. Given that you have a 5 year horizon, you can be up to 70 to 75% into equity and the rest of it as a debt in your portfolio. So, that's level one check. Level two, we're talking about equity fund investment. And, since we can't and we should not go very aggressive, what I suggest is to diversify across at least four funds to start off with. And, as and when you have some more money or you're doing a step up, you can also increase the number of funds. What I'm suggesting is a portfolio which would be roughly 50% to 60% large cap, and the rest of it would be a mid and small. So you're getting a good mix. Certain schemes that you can invest into over here, I would suggest you go in for an ICICI Pru large and mid, an SBI Contra. You can also go in for a Kotak emerging fund and an HDFC small cap. So I've spread out across AMCs, I've spread out across styles and different market caps for you. Hopefully, this should meet my return objective, my risk objective as well over here.
Any other question, Mr. Jayanti, that you want to ask Shweta?
No, that's it for now. Thank you very much. If
All the best.
I will, yeah, thank you.
Sure. All the best. Let's move on and let's take Mr. G. Mahindran's question. And Shweta, he says that I'm 70 years old and he wants you to suggest funds where he can invest. So we don't have him on the phone line. We have no idea about his risk profile, 70 years, whether he already has everything else taken care of. But quite challenging for you to actually give him a solution or a portfolio recommendation. So how have you worked that out?
So, okay, I'm going to start off with saying, sir, right now I don't have clarity on your investment horizon, but as a basic principle, what you should do is whatever money you need for the next, let's say, 2 to 2.5 years, that portion of money you should park it in fixed income instruments, which are highly liquid and will give you a stability in terms of your return. And whatever money you have, which is, let's say, beyond a 3 year holding period, there you can again follow a asset allocation of, let's say, 70 to 75 equity and the residual towards debt. You'll have to repeat this cycle every 3 years. So, at the end of 3 years, again, go back and have whatever for the next 3 years you need as debt and the rest of it into your 70-30 mix. Certain schemes that you can go ahead for your debt or equivalent allocation, I would suggest you go in for arbitrage funds. They are tax efficient. So you can go in for an SBI and a Kotak arbitrage fund. For the equity component of your portfolio, here again, I'm suggesting a balanced portfolio. You can go in for an ICICI Pru dividend yield fund, an HDFC focus fund, a Kotak multi-cap fund, as well as a DSP equity opportunities fund. So a little large cap heavy portfolio, but little mix of mid is also what you will get through this. That's, I think, my recommendation with the limited information I had.
All right, let's move on and let's take Mr. Suresh Babu's question again from Hyderabad. And he says that he wants to invest in fixed income mutual funds that can give him more than 8.75% interest post-tax. And currently, he got it through public sector banks. And he says that he wants to achieve the same via mutual funds. Interesting question. And looking at the rate cut scenario, we can definitely see good returns coming if at all he wants to have a debt mutual fund approach. But then still 8.75%, that's a little aggressive. That's being very aggressive. Shweta?
Yes, that's a huge ask from debt funds at this point of time. And anyone who's giving you an 8.75, please understand there is some element of risk you are taking. It's either a credit risk or an interest rate risk or, a liquidity risk. One of the risks is getting priced in over here. So if you're getting that 8.75 when the government paper is hovering around 7%, you have to choose your risk wisely is what I would say. And like I said, if you are looking at debt options, then debt funds, if you're going in for a government paper, which is your best credit quality, you would expect around 7%, but they're not very tax efficient if you are in that highest tax bracket. Alternatively, you can go in for arbitrage funds because they'll be taxed as equity for you, and they'll also give you pre-tax around 7.5%. But if you stay invested for more than a year, you'll have a 10% taxation on it. So that can be one alternative you can choose with a very low risk that you would be taking. Yes, optionally, if you go in for debt funds, there is an element that you will get your 7% through the yield. But if there is an interest rate cut, you will benefit from some upside that could come in over there. But like I said, you're going to be taking an interest rate risk to that effect. In that case, you can go in for target maturity funds. You can go in for an SBI target maturity fund or an HDFC target maturity fund of 2028-29 maturity. Third option, I would say that if you have a longer term horizon and you're targeting a return which is more than 8-9%, you can also consider equity funds, because if your horizon is 5-10 years, then equity has the potential to give you double-digit returns. That's been the past track record, and given the way economy is going, that's very much a possibility. So certain funds that you can, obviously consider for that also, I would suggest DSP Equity Opportunities and SBI Infrastructure and ICICI Proof Focus. Some of these funds you can consider.
All right, so that's the recommendation for Mr. Babu, and it's time up on the show as well. Thank you so much, Shweta, for being on the show and helping our viewers. And I'm going to leave our viewers with our WhatsApp number and email ID. So do send us your questions for your life financial planning on the show. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.